modern investor has access to more information about markets and investments than at any other time in history. Powerful online tools allow you to research company financials, price history, and more. But with all the information, you have to be careful that you don't get misled. In the next 3 minutes, I'll highlight some of the most common investing myths so that you can be a more informed investor. First of all, many investors have been taught over the years that the best investment strategy is to buy and hold forever. You shouldn't buy a stock and then close your eyes. The modern approach is not buy and hold, but rather buy and protect. Sometimes good companies have poorly performing stocks, and you don't want to suffer the losses when the price drops. You should certainly be diligent in your analysis of a company before you invest. However, companies and economies change, and those changes may adversely affect your stock. When that happens, you need to be sure you have an exit plan so that you don't suffer a catastrophic loss. Chasing performance when investing is risky business because you're looking in the rearview mirror. Historical performance is important, but what's more important is selecting products that fit your overall investment objectives. Your investment objectives should guide the kind of portfolio you create. Assembling stocks, bonds, and funds in a diversified, balanced way may help reduce the overall risk of any one investment in your portfolio. Finding out more about the fund family and fund manager is also a good idea to determine the experience behind the fund. Myth number 3 is charts are for traders. A stock price chart is the primary tool of what's known as technical analysis. That's the analysis of the history of a stock price. Some people believe that active traders use charts in some arcane way, but they have no place among investors. But stock charts are important tools to help understand where the buyers and sellers have shifted control back and forth. The key concept with price charts is they are primarily to be used to help us manage risk. They're not crystal balls for predicting future stock prices. When used correctly as part of a complete fundamental and technical analysis strategy, charts can help you simply better understand the stock you own. The fourth myth is buying stocks at the bottom because you believe they'll eventually recover. The temptation is strong. You begin to imagine how many shares you can afford and how much money you'll make if the price goes back up. But let me ask you, how do you know you're buying the bottom? I've seen many investors buy stocks at $5 because the stock was recently trading at $50. But after they bought, the stock dropped from $5 to $1. When you buy a stock that's on a 52-week low, you're making a bet that your buy order will be the catalyst that turns the stock from a downtrend to an uptrend. If the sellers have been in control of that stock so that the price drops for a year, is it really reasonable to think that you're going to be able to predict the bottom? Rule number 1 in trading and investing is not to win big, but to make sure you don't lose big. Understanding the risks associated with various investments and then managing those risks provides the foundation for long-term success. Learn more about smart investing with E-Trade's free trading tools, webinars, videos, platform demos, and live events. Thank you for joining us.